There is without a doubt that we are currently going through a major property boom here in Australia, and we are seeing significant capital growth in all major cities and most regional markets. Sydney saw a growth of 3.7% last month, which equates to a 40,000 increase to the median house price, which is absolutely insane. And the other capital cities were not far behind, with a capital growth of around 2.5%. Even the apartment markets that I hate so much are starting to see an increase in activity, with record low levels of supply, extremely high levels of demand, and record low interest rates increasing our borrowing capacity, as well as Aussie households sitting on record levels of saving from their super withdrawals back in 2020 and their inability to spend money during our lockdowns. The buyer sentiment in our market could not be stronger, nor could the level of competition between first-home buyers, owner-occupiers, and investors who are now starting to re-enter the market. It's very hard to believe that the growth that we are seeing in our markets will slow down one day, but it will. And this is something many eager buyers are struggling to see or refusing to believe. When property prices are increasing by tens of thousands of dollars every single month, it is hard to see the market ever turning. But it will. In today's video, we are going to talk about some factors that could put a stop to our red-hot property market, as well as answer the question, just how much higher can property prices go? We are going to take a different approach today. Instead of just listening to my personal opinion on certain topics, we are going to look at the math behind borrowing capacity, interest rates, medium incomes, and debt serviceability, as well as go over some predictions from the major banks to get an indication of just how much more growth we are likely to see in the current property boom. As always, what you see in front of you is not a financial advisor, and therefore this cannot be financial advice. I will always encourage you to do your own research and due diligence and come up with your own investment strategies and consult with real professionals before doing anything crazy. And without further ado, let's get straight into the video. Let's start the video with some predictions by our major banks. After all, these institutions are the ones lending out the money, so they should have a good understanding of what's going on in the markets. We will start with this prediction from ANZ, which predicts a 17% growth for 2021, with a growth rate of 19% for Sydney and Perth, 18% for Hobart, 16% for Melbourne and Brisbane, and 13% for Adelaide. Now, I know these predictions might seem very ambitious and very high, but at the current rate of growth that we are seeing in our markets, most of our capital cities are on track to hit 20% this year. At the current growth rate, Sydney will hit a growth of 30% in 2021, adding more than $300,000 to the median house price and increasing it to $1.5 million. This is a crazy number and will be unaffordable to most of the Australian population. Even the current median house price of just under $1.2 million is out of reach for large proportions of Australians. So we have to wonder, with our borrowing capacity already maxed out at the current record low interest rates, how much more room is there for a market as expensive as Sydney to grow in the coming years? According to this article by savings.com, Australia's biggest bank, the Commonwealth Bank of Australia, forecasts a growth of 16% for the next 2 years, which breaks down to 9% in 2021 and 7% for 2022. This article then goes on to say the reasoning behind this bullish prediction is a sharp increase in new lending, an increase in turnover and sales volume, high clearance rates, and the consumer sentiment survey reflecting optimism. In the current record low interest environment, I believe these estimates are actually quite conservative, with changes to the responsible lending practices soon to be implemented, as well as CBA dropping their short-term fixed rates. It shows that the banks expect a better lending environment in the coming years. These factors provide the perfect conditions for the markets to keep growing in the coming years. What really caught my attention was the recent changes to CBA's short-term and long-term fixed rates, with the bank lowering its 1-year fixed rate by 0.1% and 2-year fixed rate by 0.2%. This shows the bank expects the interest environment to become more favorable in the next 2 years. However, the 0.2% hike to its 4-year fixed rate shows that the bank expects rates to start rising sooner than expected. Now on to Westpac and NAB. Westpac forecasts a growth of 10% in 2021, followed by another 10% in 2022, while NAB is much more conservative and have forecasted the lowest growth out of the big four banks, with an 8% prediction for 2021 and a 6% prediction for 2022. If you look at the four very different predictions from the four major banks, we can quickly become confused about what to expect for the rest of 2021. However, the common consensus here is that the markets will perform very well for the rest of 2021 and into 2022. I personally believe a growth of around 10 to 12% is what we are likely to see for 2021, provided that there is no government intervention to address the runaway house prices. If there is government intervention, it will be a completely different story. Like we saw back in 2017, government intervention can quickly cool the market or even send the market into reverse. Even if the government does not intervene to address the runaway house prices that we are currently seeing, there is another factor that could limit the growth we are likely to see for the rest of this property boom. Now, we all know that our income and wage growth is completely stagnant. And with our borders closed, we know that there is no migration coming into Australia to increase our population. So if there is no income growth and there's no population growth, then what's driving the house prices? And the answer here is debt. As much as the banks would love to lend us unlimited amount of money to maximize their profits, they need to make sure that we are able to repay these loans so we don't default on them, because this would be bad for their profitability. With our housing market being one of the most expensive in the world and our mortgage debt at a level that surpasses most developed countries, we have to wonder, how much more money can we borrow to further push up house prices? There will come a point when we can no longer borrow more money to push up house prices because our borrowing capacity is already maxed out, and I believe this point will come very soon. So let's crunch some numbers to see when this is likely to happen. I wanted to find the median income, so I went on the ABS website and found this table, which shows the median weekly income for each state. What is very surprising here is that it shows that our most expensive property markets, Sydney and Melbourne, do not have the highest median income. It's in fact Western Australia and ACT that have the highest median incomes, with mining returning to Perth, and Perth being one of the most affordable markets in Australia. I will be keeping a very close eye on the Perth market in the coming months. Let's use New South Wales and the median income of $1,751 a week as an example. Using this income and tax calculator, an income of $1,751 per week will mean an annual income of $69,172 after tax and Medicare levy. I put the income of $69,172 into the NAB borrowing capacity calculator and enter a living expense of $1,000 per month, which is extremely low considering how fast the cost of living is rising. A 30-year mortgage with a 2.5% interest rate as an owner-occupier, the calculator gave me a result of $696,000, meaning that someone with medium income in Sydney will be able to purchase an $870,000 property, provided that they have a 20% deposit. This means that a large percentage of people in Sydney are already priced out of the housing market and will have to settle for apartments and townhouses. Bear in mind, just because the bank is willing to lend you this much money, it does not mean you should borrow this much money. At the current record low interest rates, your monthly repayments will be $2,750, which is 47% of your income. And if the interest rate goes up by 1%, your repayments will increase to $3,330, which becomes 57% of your income. Please always borrow within your means and take into consideration the long-term interest rate and take advantage of fixed rates that you can lock in for a long period of time. Another scenario that is becoming more and more common is when there are two people contributing to the mortgage. I used the calculator and added another borrower with a $69,000 a year income and $1,000 of monthly expenses, which is once again extremely low. But for the sake of keeping things simple, let's proceed with these numbers. This will allow the couple to borrow up to $1.4 million and purchase a house worth around $1.7 million, provided that they have a 20% deposit, which is a cool $350,000. This means they could easily borrow more money to further drive up house prices in Sydney. On top of that, the high income earners in Sydney and the wealthy migrants will continue driving up prices for the years to come. Just kidding. Once we take into consideration their car loans, their credit cards, or children and dependents, their borrowing capacity will reduce very significantly very quickly. If we add $1,000 a month in repayments for the two cars that the couple most likely have, a $5,000 credit card limit, and increase the living expenses to a more realistic $4,000 per month, their borrowing capacity quickly goes down to $1.1 million. Let's be honest, saving up a 20% deposit of $300,000 is very hard, and most people are not going to have this kind of money. meaning that when they purchase a property, they are going to put down a much lower deposit, maybe a 10% deposit or even a 5% deposit. This means they will have to pay lender's mortgage insurance, and because their LVR is so high, they will now have to face a higher interest rate, which is going to reduce their borrowing capacity, meaning that even as a couple, most households in Sydney are going to struggle to afford a house with $1 million price tag. However, this affordability example is based on the numbers from our most expensive markets. If we then look at markets like Darwin and Perth, which have very high median incomes, as well as any other market that is not Melbourne, Sydney or Canberra, affordability is not going to become an issue. For example, based on the median income of $1,840 per week, a Perth worker will have $72,204 after tax and Medicare levy. Even after adding $1,000 per month for car repayments, a $5,000 credit card limit, and $2,000 per month for living expenses, they could easily afford a property at the median house price of Perth. In my previous videos and on my Instagram, I have mentioned so many times that I will be staying away from Melbourne and Sydney. And this is one of the main reasons why. I simply see more potential in the more undervalued markets of Australia. In conclusion, with our property market seeing such strong growth in the first few months of 2021, I personally believe this growth is likely to slow down in the coming months as affordability becomes a constraint and as stock levels start to increase. Based on the forecast by our major banks, which is in line with my personal opinion that our property markets will grow by 10 to 12% in 2021, the different markets of Australia still have a bit of room to grow. However, I personally believe Melbourne and Sydney will no longer be the best performers in the coming months as affordability constraints start to kick in. I know some of you guys are not going to agree with me, and that is completely fine, and I could also be wrong. But this is what the numbers are telling me. I will always encourage you to do your own research, and please let me know in the comment section below if I missed anything or if you disagree with anything I've said. Thank you for watching this video to the very end. It really takes a long time to make these kind of videos, so if you got value from this video, please return the favor and support the channel by hitting that like button right there and subscribing for more content just like this. And I'll see all of you guys in the next video.